Welcome to my M&A crash course or M&A 101. M&A simply stands for mergers and acquisition, as you might have rightly guessed. It's all about companies buying, selling, and combining with other companies. And this is usually done for strategic reasons. It could simply be for growth, for transformation, or simply to survive a competitive market. And a merger happens when two companies decide to come together as equals to form a single new entity. Well, it's not always that they come together as equals, but it is often positioned as a partnership of strengths where you have two management teams combining resources, customers, and capabilities under one roof. An acquisition, on the other hand, is when one company, which is normally referred to as the acquirer, purchases another, which is the target. So here we have the target remaining as a separate subsidiary, or it might be fully integrated into the parent company, which is the acquirer. In some cases, acquisitions are friendly, and in other cases, they could be hostile. As you will find shortly, one way to acquire a company is by buying the shares of the target company. So normally, in a hostile situation, you have the buyer going directly to the shareholders instead of to the board to buy a significant number of the target company shares. That makes the acquirer take control of the target company. And one classic example was the attempted takeover of Hermes by LVMH. And what happened was, in 2010, LVMH announced that they had quietly amassed about 17% stake in Hermes without the family knowledge, because Hermes is run by a board of family members, right? So without their knowledge, LVMH had bought about 17% of the company. So here, LVMH was literally acquiring the entire company gradually with an attempt to take control without launching a formal bid. So that is how hostile an acquisition could be. In 2017, Whole Foods Market, a very famous company, was bought by Amazon for $14 billion. And quite recently, we have Microsoft completing its purchase of Activision for a staggering $17 billion. All these are examples of M&A deals, and they are usually structured in one of these two ways: as an asset sale or as a stock purchase. In an asset sale, you have the buyer purchasing specific assets and liabilities of the target company rather than buying the entire company outrightly. Think of it as the company buying what they want to buy and leaving what they don't want. And it could simply be the equipment of the company, inventory, intellectual property, or even the customer contracts, and also choosing which liabilities to assume and which ones to avoid. Now, in a stock purchase, which is also known as the share purchase, you have the buyer purchasing ownership of the entire company by buying its shares rather than individual assets. It is important to note that a buyer would elect one of these for specific reasons, because each of these has got its own tax and legal implications. For instance, if you went for an asset sale, for tax purposes, the buyer gets a step up in the tax basis of the assets, which can lead to further tax savings through higher depreciation and amortization. But these are some of the technicalities of M&A, and of course, an accounting lingua, which we could explore further in subsequent videos. Now, in mergers and acquisition, the buyers typically fall under two broad categories. One, either they are corporate buyers, also known as strategic buyers, or either they are private equities, which is also known as financial buyers. With corporate buyers, these are usually operating companies that acquire other businesses to enhance their own operations. And this is where you would hear one of the most important terminologies in M&A: synergies. When strategic or corporate buyers acquire a company, they are looking for what we call synergies. And we could define synergies as the extra value created just because two companies combined, meaning this extra value was non-existent when the companies operated individually. And the synergies could be an efficient way of saving costs just because the companies combined. It could be growth in revenue, market expansion, and so on. For example, Microsoft purchased LinkedIn in 2016. And at the time, LinkedIn as a separate company had a vast data on skills, job history, and company information. This was value that Microsoft beautifully integrated into its Agile AI and analytics. So I would say it helped Microsoft improve its enterprise insights, talent management, and predictive modeling. This was a real value, i.e. a synergy, which was only possible because of the acquisition. Because of this, strategics are usually looking for other companies that are in the same or in a related industry that fit into their business model, because they intend to have a long-term ownership of the companies that they buy. When it comes to funding, usually strategic buyers or corporate buyers usually use cash from their own balance sheets or issue stock to fund the acquisitions. A buyer in the second category could be a private equity buyer also known as a financial buyer. These are investment firms. They acquire companies primarily for financial returns. Here too, we introduce another important terminology, which is leverage buyout, famously known as LBO. They typically use a mix of their own capital and debt, and the term leverage buyout is quite self-explanatory to say that they use a lot of debt. Usually, about 70 to 80% of the offer price is financed by debt. Remember, these guys are buying primarily for financial return, so keeping the company for a long term is never part of their strategy. They aim to improve the company's performance and sell later at a profit, usually within 3 to 7 years. So they seek to generate high returns for investors by restructuring or streamlining the operations and exiting via an IPO or sale to another buyer. Some of the famous private equity firms, we have Blackstone, we have KKR. And a good example of this was when Blackstone bought Hilton Hotel Corporation in an all-cash leverage buyout, valued around $27 billion, one of the highest private equity deals at that time. So this is a very simplified overview of the Blackstone Hilton LBO, the deal and the deal structure. So like we've already explained in the video, the acquirer is the buyer, and in that deal, Blackstone was the buyer. And Hilton Corporations, or the Hilton Hotels Corporation, was the target. And the deal value, sometimes referred to as the offer value. This is how much Blackstone was offering to pay for Hilton Hotels Corporation, and it was a staggering $26 billion. The deal structure, like we've already explained, could either be an asset sale or a stock sale. In this deal, they were buying, or they purchased using the stock sale, and it was an all-cash operation. If you look at the share price that Blackstone offered was $47.40 per share, and a premium of 40%, meaning that whatever the share price was for Hilton hotels at that time, they were paying 40% more to complete this deal. So that is why the deal was completed on a premium of 40%. And if you look at the funding or the financing structure, like we already said, this is an LBO, and we explained LBO to mean a leveraged buyout. Debt is a major part of the financing structure. So if you look at the offer deal or the total deal of the operation, which was $26 billion, $20.5 billion of that was being financed using debt. All right, so we can say that 20.5 over 26, roughly 80%. So roughly 80% of the offer deal or the offer price was financed using debt, and that explains the whole structure of an LBO. And it is also very interesting to know that before the purchase or before the sale to Blackstone, Hilton was a publicly traded company. Hilton was actually listed on the stock exchange. All right. So because of that, they had to go through what is known as the take private leveraged buyout. It is still a leveraged buyout, but now they had to delist it. They had to take it back and manage it as a private company. So Hilton was delisted. And like we said, the main objective of private equity buyers or financial buyers is not to keep the company for a long time. All right, their main objective is to make a lot of money from their investment. So the term of investment was, I think, for 6 years. That was how long Blackstone held onto Hilton Corporation companies. All right, so the whole objective here is that we are buying you from the stock exchange. We are delisting you. We are managing you as a private company. Now, we are going to look deep down into the structure of the business. We are going to improve the structure, the management. We are going to make sure that this becomes a very good business for other people to want to buy it or to want to invest in it. So after the 6 years, what they did was they sort of sold it back to the public, right? So they had to put it back on the stock exchange through an IPO, okay? And some sources say that they made about $14 billion in profit. Other sources say 18 billion in profit. But well, if we should even take 14 billion, if you remember, the equity investment was 5.6. This was how much of their own money they invested in the LBO. And the profit, even if it should be 14 billion, meaning they made around 250% in profit. Yes, so that is the whole view of an LBO. Like we said, their main objective is to make their investors a whole lot of money. And that is exactly what these guys do. So in this video, we've captured the basics of mergers and acquisition. In the next episode, we will take these concepts further and start looking into the numbers behind the concept. If you enjoyed this video, kindly hit the like button, subscribe, and you can share it to someone else. Thank you very much for watching, and I'll see you in the next one.